Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, happy Friday. Welcome to the COB on what has been a wild week. I'm Juliette Sarli. Nadine and I were just saying we can't believe that big movement in CSL was Monday. It's been such a big week. We thought it was a week or so ago, but you think about that, you think about the big sell-off in CBA this week, the fact that BHP reclaimed its mantle as the most valuable stock, all of this happening alongside a federal budget, alongside President Trump and Xi meeting in China, and alongside hotter than expected inflation data in the US. I'm sure I'm missing things as well. Obviously, what's happening with UK politics. So an incredibly busy week. Let's have a look at where the local market has finished the day's session and the week's session. Not moving too far there on the CBO 200. The S&P ASX 200 is weaker, down 0.2% as we head into match off 19 points, 8,621. Now, over the last 5 days, it's down 1.4%, which means we are now 1% lower than where the S&P ASX 200 started 2026. So, as I mentioned, wild week. Let's get into the themes, though, of the day. And today was about a resource retreat. So BHP and Rio coming off their records, MinRes diving on this Managing Director Chris Ellison stake sale, a nice cool 120 million going into his bank account. That saw the materials sector ease by 2.7% and really weigh on the overall sentiment on the market, despite a pretty good movement in tech stocks, in energy stocks, in industrial, in financial stocks. Beijing bond, China urging the Strait of Hormuz reopening. And of course, there's been talks on the overall Iran war. US President Trump saying he wants America to do more business with China. And we also had that agreement that China will buy 200 Boeing planes. It was weaker than around, or less than I should say, around 600 planes that the market thought that China might agree to buy. So you did see Boeing shares down about 5% overnight. But we've also got comments here on how many US soybean sales to China there will be. And also rare earths, America says they're back to better levels there. Chinese stocks slipped though, and oil has climbed. And then property plunge. Well, HSBC expecting Australian house prices to fall over the next 2 years, warning that higher interest rates, weaker investor demand, and new tax settings, courtesy of our federal budget, combining to cool what has so far been a resilient housing market. Let's have a look at the miners. BHP coming off those record highs, $60.45, still pretty punchy. Rio Tinto, $186.13, and Fortescue down by 1.4%. The banks, though, reclaimed some ground. So CBA, which of course has had not a great week at all, up by 2% today to $159.08. ANZ, the firmest out of the rest of the big four, by 0.8% gain. And then tech stocks looked pretty good today as well. Xero there, up by 8.5%. So certainly investors buying the dip after it was sold off yesterday. Now, Mineral Resources was the worst performer. It dived by around 8% after, as I mentioned, the Managing Director Chris Ellison sold 1.75 million shares worth $122.5 million in his first on-market disposal in 9 years. Tech, though, the strongest, with Xero rebounding after falling by around 9% yesterday. Electro-Optic Systems, it also rose. It's preparing to take control of the Mars Defence Technology business in the coming days. And Vicinity Centres was also higher after striking a $400 million deal to acquire the Eastern Creek Quarter retail precinct in Western Sydney from Fraser's Property, settlement due on the last day of the financial year. Treasury Wine Estates also higher. The French billionaire Olivier Goudet lifting his stake in Australia's biggest wine company, spending $31 million to take his holding to around 9%. Let's welcome to the COB our Friday guest, Shane Oliver from AMP. Great to see you on what has been a wild week, Shane.
It certainly has been, and great to see you too, Juliet. An interesting week, I must admit. The budget delivered a lot of things that had been flagged that it would deliver. That said, I was a little bit disappointed by it. The government spending is still way too high. We're still lacking decent tax reform, and the productivity measures were somewhat lacking. I mean, maybe they didn't get enough attention, but I sort of was a little bit disappointed because the budget is 2 years away from the next election. They got a huge increase in majority in Parliament. If they were going to do anything dramatic, now was the time to do it. Some might say, well, they did that with the needed gearing capital gains tax changes, but if that's all there is, then I think that was a little bit disappointing.
Yes, indeed, and I've read a lot of your commentary on what we've seen with the budget. But let's talk as well what's happening more globally. Your colleague Meebui has just written your weekly market update. Do markets still care about Hormuz? Do they?
Well, you could ask that question about the US because it certainly looks like it doesn't. The US share market at record highs. It's been refocused back on profit numbers and mostly good economic data coming out of the US. Other markets outside of the US, I think, are a little bit more concerned. They haven't been as strong. Japanese market certainly has been, but when you look at Europe, they're still below record highs. Likewise in Australia, and the Australian market, really been weighed down there. So, but I think the broader issue is that equity markets often have relatively short horizons. So if you go back to March when the war started, they get focused on that. Nothing dramatic happened in terms of the economic data. Then we moved into profit reporting season, and investors said, well, hey, who cares? Profits are up 28%, tech profits are up 60%. It's time to be long, not worrying about what's going on in the Middle East. But the reality is that the Strait of Hormuz is still closed. And as Meebui points out in that note, the IEA has warned that global stockpiles are falling rapidly, and there will come a time, not too far away, if this continues, where we'll run out of those stockpiles, and we'll really have to face the 10 to 15% reduction in global energy supply or oil supply, which means a 10 to 15% reduction in global oil demand. We're not at that point yet, but each day goes by, we get closer to that point. And I think what's also happened here is that there was a lot of expectation that Trump and Xi would come to some sort of agreement whereby China puts pressure on Iran to help open the Strait of Hormuz. In the event, we saw nothing along those lines, just the Boeings and the soybeans, which to my mind is trivial in the great scheme of things and hardly resolves the trade differences between the two countries. But most importantly, we saw nothing in terms of the Strait of Hormuz, and that's why you've seen the oil price edge back up again, with West Texas above $100 and Brent certainly staying above $100. So the risk is still there, that we could yet still see higher oil prices, and that risk grows the longer the strait remains closed.
Yeah, and the longer, I guess, the downside risk to economic growth, the upside risk to global inflation. A lot of what's driving the US momentum, though, is these big tech companies. We've got Nvidia in focus next week as well. These booming profits really just lifting Wall Street to records.
They certainly are, and we've now gone back to where we were earlier this year, with tech being the driver. You may recall, as we went through February, there was a bit of a rotation in the US share market away from tech and towards other market. The equal weighted S&P 500 was doing well and outperforming the S&P 500, which is dominated by tech. So we were seeing that rotation towards cyclicals. That got blown out of the water to some degree by the events in the Middle East, and now we've gone back to tech. And of course, that's been reinforced by the strong profit numbers. You're right, we get Nvidia on I think it's Wednesday from memory. It's usually Wednesday, but anyway, in the week ahead. It's odd in a way. The US profit reporting season used to be over with nice and quick, all done within a month. I think now it seems to drag on. We're now way past the end of the quarter, April well into May. So it's taking longer to get their profit reporting season out of the way than it takes in Australia now, whereas in Australia we're wrapped up within a month. But anyway, Nvidia is the final big one to watch. But I suspect at some point there they will start disappointing. Not so much that they won't see strong profit growth, it just won't be as much as the market's been hoping for. And that does present a bit of a vulnerability. And when you look at the US share market, it's done pretty well, and I don't begrudge it. That's done fantastically well, and the profit numbers are fantastic, but it's becoming more and more concentrated. When you look at the number of stocks above their 200-day moving average, it's in decline. So that's not a great sign in a sense, and that's why you do have these concerns that it might be becoming a bit bubbly.
Certainly bubbly indeed. All right, let's get back to our economy. You touched on the budget, but we also had some business surveys out this week. Pretty bad on that front. Things looking a little bit gloomy. What does that mean for the RBA?
Well, they're looking a bit gloomy in a sort of a stagflationary sort of way. Very low levels of business confidence, consistent with very low levels of consumer confidence. And then on the flip side, though, we're seeing very strong gains in the price indicators within the NAB survey. And that, one reason I was optimistic up until a few months ago on inflation was that the NAB survey price indicators, particularly for final prices, were around levels that we saw pre-pandemic, whereas now that's totally gone. For the last 2 months, it's shot upwards. Final prices, labour costs remained under pressure. We saw yesterday the ACTU now raising its request for now a 6% wage rise in the minimum wage case, and of course purchase price costs in the NAB survey also rising, almost at levels that we saw back in 22-23 with the supply side shock back then coming out of the pandemic and the Ukraine situation. So that's a bit of a concern for the Reserve Bank. I tend to think the Reserve will probably give primacy to the inflation threat. History tells us, if you go back to the 1970s, that when you're faced with a threat to economic growth and a threat to inflation, you're usually better off focusing on getting that inflation situation under control first. Otherwise, you run this danger that you end up locking in high inflation and then weak economic growth at the same time. So I suspect that the Reserve probably will hike rates again. And unfortunately, the budget really didn't take much pressure off the Reserve Bank. There is some spending savings over the next, say, 5 years, but they really come later in the forward estimates period, later in the decade, in other words. In the near term, the budget actually pumps more money into the economy. So that's a bit of a concern. And, we left in place our expectation that the Reserve will hike rates again at their August meeting.
Yeah, what does all it mean for home prices then too? Because we've had this housing finance weaken in the March quarter, the impacts of the budget too. I know we're trying to get housing more affordable, but what does it mean in terms of some of this data?
Well, I think we do go into a period where house prices fall. We were looking for house price growth to slow to 3% this year after 8.5% last year. Higher interest rates are a factor there, poor affordability, uncertainty, poor confidence associated with the oil supply shock, and now you throw into the mix, and you could have done this last week as well. We were starting to focus on that in the last few weeks, in fact. Now you've got this change in the tax setting, which impacts investors. So if you look at the housing finance figures that came out Wednesday, investors were 40%, just over, as a share of total housing finance, so they're a big part of the market, but an investor now will say that my after-tax return in the property market is going to be lower than previously. Therefore, to get into property, either I have to go into a new property, and there's only a little narrow point there because new property is a small part of the market, or I will want to see higher rents or lower prices. In other words, a higher rental yield to compensate for that lower after-tax return I'm now going to get, which means the rents have to go up over time or prices have to come down. I think it's probably going to be a mix of the two. And therefore, our rough estimate suggests that the tax changes alone will knock about 5% or so off property prices, probably front-loaded over the next 6 to 12 months, I would think. And therefore, we probably will now dip into negative territory. We're already getting there in terms of Sydney and Melbourne. Prices there have been falling and weak for the last few months now. The other cities, Adelaide, Brisbane, Perth, they were all slowing down, but they're still positive. But I suspect as time goes by, they come under pressure as well. This, I think, is just a temporary thing. Prices sort of do this over time. They'll have a bit of a dip. Investors will then say, okay, it's attractive again to get back in, and then prices will resume their rising trend on the back of the undersupply problem we have in Australia, of which the budget, I don't think, does a lot to address. We've been struggling to address that one for the last few years now, but we haven't made a lot of progress, and we're still underbuilding relative to the housing accord, and I think that's probably going to continue.
Let's end on a high, Shane. The only sort of good positive thing that's been going through my head today has been Delta Goodrem's incredible Eurovision performance, getting her into the grand final. I know you would have watched it too, and if you haven't, you'll be getting up at 5 a.m. to watch the final. Do you think Delta can win Eurovision for Australia, which is clearly part of Europe?
Well, it's possible. I mean, I got really excited with Dami Im, I think it was. Was that 2016 16, a long time ago now. Time has gone fast. I've even got her album sitting over there on the shelf somewhere. Look, I think there's a good chance. It'd be odd, though, if Australia wins and we're not actually in Europe, if we win. I mean, it'd be like an amazing feat, but ultimately technicality. So it's fantastic to see Delta getting through to the grand final, and I'll certainly be watching it. I mean, Eurovision's one of these things you have mixed feelings about, but because I kind of like dorky dance music in some ways, it's the sort of thing I would like to watch on occasion. And good stuff has come out of Eurovision, you might add, in terms of what happened through the Cold War, because that's when it started. They were trying to send a positive message in the Cold War when it started. I think the Russians and the other countries on the other side tried to replicate it, but it never quite worked. But don't forget, ABBA came out of Eurovision. Waterloo was their entrance for Sweden in 1974, and it really set off ABBA into superstardom from that point onwards. So it is a good thing. I think it's a great thing that it brings countries together like this, and it's also great that they let Australia participate, even though we're not physically part of Europe, but we do kind of relate to them.
Technicality. Yeah,
Technicality. Well, I mean, we've had enough of America lately. Trump has annoyed us. My son keeps telling me that I could look like Donald Trump if I combed my hair the right way. But,
no,
which is kind of embarrassing.
No.
So,
you don't look anything like him.
So,
I mean,
if I get a red tie, bit of makeup, then maybe I could do it. But Europe's the place, I think.
Europe is
not
the
America,
place.
Anyway, for holidays.
Well, go Delta. I'm excited. All right, Shane, really appreciate it. Have a lovely weekend. We'll talk to you next week. Thank you.
Sounds good.
Shane Oliver there, the chief economist of AMP, and I knew he'd be a Eurovision fan. I didn't even have to, worry that he wouldn't have a response to that question. All right, the stock of the day on the call was Xero. Nadine spoke with Kai Chen from MPC Markets, Philip Pepe from Sharemarket Partners.
I also like to look backwards and project forwards and say, well, versus its history, it's cheap. Yes, so what? Is the history still relevant? Analysts will tell you it's a screaming buy because there's a 65% plus expected return despite the 71 times PE. I would sit and wait. I wouldn't rush out and sell it because it is a good business. I think this will evolve more slowly than the share price reaction has suggested, but it will evolve. If you owned it, I would sit it, put it in the bottom drawer, wait and see what happens. I wouldn't chase it until we get more data. If you didn't own it because it's not particularly cheap. So I'll call it a hold, a wait and see. Great business, probably not going to, the share price probably has overreacted, but it's too early to call it a buy.
I still think, going at it today, I think it's a valuable company. It's got a huge subscriber base. Its revenue has been pretty good. So I have a bit more tendency to hold, and they've done well in the US as well in terms of the acquisition with Milo. So it's okay.
10 stocks picked by you, 2 experts, 1 hour.
Let's get to the companies that have been nominated by you.
It's like a witch hunt over there. Everyone hates data centers.
Just remember that most of their earnings are offshore, so there's no franking credits.
The call is brought to you by Centuria, an ASX-listed property fund manager with $21 billion in assets under management. Want to diversify beyond equities? Explore the Centuria Sydney CBD Prime Office Fund at centuria.com.au.
We have finished the day and the week's trade. Let's have a look at some of the winners of the day's trade, including Xero, which is our stock of our day, as you just heard, up 8.5%. 4D Medical also had a good day, up by more than 10%, and Fletcher building up 4% on its update to the market. The laggards today included Hyperion X and Mineral Resources due to that Chris Ellison stake sell down, off by 8%. Let's have a look at the small end of town. Pacific Edge had a good day, up by more than 48%. Doug Tech up by around 8%. And the laggards in the day's session included, I love it when you see the Brisbane Broncos. The first time I ever saw that, I said to one of our co-anchors who is no longer with us, but you might remember Danny, I was like, is that related to the NRL? And apparently it is. And so Brisbane Broncos didn't do well today, down 16%. Who knew they were listed? Global metal mining down by 11%. All right, let's have a look at what we're getting out tonight. ECB Economic Bulletin due, the US Empire State Manufacturing Index, and April industrial production for the US. Next week, we have NVIDIA earnings, of course, in focus. All that data dump coming through from China as well on Monday. We'll get the RBA May minutes too on Tuesday. And I believe Wednesday is when we'll get the FOMC minutes. So not as busy a week as what we had this week, but still a fair bit around, and that NVIDIA one will be key. Had a great chat to Ilya Spivak from Tasty Live saying, as I guess most analysts are saying, this is going to be a litmus test for the AI momentum. Let's have a look at where our market has finished the day's trade. Very flat there on the CBO 200, while the S&P ASX 200 has finished the day and the week's trade lower by around 10 points, a tenth of 1%, 8,630. It is now back to being unchanged year to date, down 1.3% on the week. All right, it's been a very big week. As we mentioned a couple of times, if you haven't caught up with all of our budget coverage, there is what we call a rail on the website. We had some really interesting conversations with big leaders in Australia about the changes, what it means to your investment, to your super, to property, to so many things. So please do check it out. And we'll catch you again from 9:45 a.m. Eastern on Monday.